Hello viewers, Assalamu alaikum. In today's lecture, we are going to talk about yield to maturity calculations for different financial assets. What is yield to maturity concept? We'll be talking about in a while. Before that, basically, we are aware that we know about the concept of present value calculations. If you are not aware about the present value calculation concept, you can go back on my channel and watch different videos related to the discount rates and the present value calculations. This particular concept we will be applying on different kinds of financial products. Like say for example, the first of all we'll be discussing about a simple loan. A simple loan is a loan contract in which the borrower repay the borrowed amount to the lender at the maturity date along with an additional payment for the interest. It is the most common type of a loan that we generally give and take in a real life. Like say for example, when you give your money to a friend, like say for example for some kind of thing, they take this money for a certain period of time, and when they return this money, they give you back along with the interest rates. Similarly, we may have got a different kinds of a contract for the loan that may be a fixed payment loan in which the borrower takes money, but he doesn't return that money in one go. He just divides that money in different kinds of installments, and that installments he pays over the time. What actually he does when he makes these installments, every installment he pays some amount of interest. So this particular kind of a contract is like a contract which actually when this payments ends, everything ends. Like say for example, the person who borrows money is able to pay back all the money and along with the interest rate when he actually just finishes the term. That is why this particular kind of a loan is also called fully amortized loans. This particular loan is a very common as well. Like say for example, when you buy things on credit from the shops, you buy things like you just make installments for those payments, and that installments basically generally carry both the principal amount and the interest rate amount. When these installments end, your whole amount basically ends, like you just are free of all the liabilities. So that is why this is also called a fully amortized loan. Another kind of a contract that basically we make between the borrowers and lenders is a coupon bond. Coupon bonds basically are very common bond as well. Like they basically are the bond which get you interest every term. Like say for example, monthly, quarterly, annually, or semi-annually. Under these coupon bonds, the owner pays the interest rate that basically is like until the maturity date. And when this term ends with you as a contract between the borrower and lender at the last installment, you get your final principal amount back as well. So this is a kind of an instrument which actually between the period, like from the time that you buy the bond and you just get it in cash from the person from whom you buy the bond. During that particular time, you don't get any principal. You just get like the interest rate. Another kind of a bond that basically is very common is a discount bond. What is a discount bond? The discount bonds basically are very much again common. Like say for example, the treasury bills, the government issues, they are discount bonds, and there are many different kinds of discount bonds available in the market. What is a discount bond, and what does the term discount means into this? The term discount means, like say for example, if the face value of a bond is $1,000 or 1,000 rupees, you will not get this bond for $1,000. You will get this bond for a discounted price. The discounted price will be definitely less than $1,000 or 1,000 rupees. So you will be getting that bond. Say for example, if 800 rupees for 800 rupees or $800, you will be when you will be just in cashing or at the time of maturity, you will be getting $1,000 back. So the difference between the price that you pay at the time of purchase and the time that you get the price that you get at the time of sale or returning of that asset is called your interest. That is what basically is the attraction into this bond. You buy at low price and sell it at its face value. So the lower is the price, the higher is the basically like is the return that you have. Like say for example, $1,000 bond if you buy for $700, your return will be $300 on your investments of $700. And similarly, if you are buying, say, for example, a bond for $600, so it means that you will be getting $400 return on a $600 investment. That is a huge return. So, like we'll be calculating and using this present value concept to understand yield to maturity. What is yield to maturity? Yield to maturity is sometimes actually a very tricky concept for economic students. YTM, which is generally called this interest, the YTM is the yield to maturity, is the interest rate that equates present value of the bond's future cash flows, coupon payments, and principal repayment and maturity with its current market price. YTM is like a return that basically is decided on the basis of, like, the value which actually makes value of the interest rate, which makes the NPV zero. Like, it's a kind of an IRR of the project. So YTM helps investors assess the total return. What is the kind of, like, use of this? This particular YTM actually provides you a benchmark interest rate. The benchmark interest rate basically helps you decide whether you have to go into investment or not. If you actually, like, say for example, you get higher returns from the IRR, you go into the investments, otherwise you don't. So this is the a kind of a benchmark rate. The benchmark rate is a basic minimum rate that you accept for any kind of investments. Like, say for example, if you are borrowing some amount from some kind of an institution and you want to make investments with it, so you will be having some kind of YTM for that project, and that YTM will be the minimum amount that perhaps you will be looking for. Now, if you use this concept for the calculation of simple loan, you must remember that this is the interest rate that equates the discounted cash flows to the price of the instrument. Like, say for example, if you are talking about a simple loan is very a kind of a simple loan that basically actually makes you one-time payments at the time of maturity. Now, if you look at the calculations for the simple loan, say for example, the value that is being borrowed is $100, and the amount that you will get in the end will be $110. So it means that, like, there is a the interest rate around is $10 on the investment, so $100. Now, what kind of investment will make its present value, like, the discounted cash flow? This discounted cash flow is, like, we are actually, like, dividing this $110, the amount that you are going to get in the future, by 1 plus I to the power 1 only, because this is one period kind of or 1 year kind of a transaction. So we are going to find out the interest rate that may equate this left hand side to the right, this right hand side to the left hand side. Any interest rate that makes them equal will be the YTM for this project. Like, say for example, if you make this calculation, you can find out that I is 10%, and this 10% is, is the YTM for this particular kind of instrument, which is a simple loan instrument. Similarly, we can use these calculations and find out the YTM for an arrangement or a contract that happens between the borrower and lender for fixed payment loans. In case of the fixed payment loans, these are the regular fixed payments a person makes. Like, say for example, if you have borrowed 100,000 rupees from somebody and you have to pay, say for example, 20,000 on it as an interest rate, so you have to pay total 120,000. So if you divide that 120,000, say for example, in 10 installments, every month you will have to pay 12,000, and that 12,000 will include both the 10,000 principal and 2,000 interest rate. So if you look at the calculations for YTM for this project, so now if you look at the way basically this particular kind of payments are made, so you know that this actually payment is made in installment. Like, say for example, the first installment will be discounted by 1 plus I. The second installment will be discounted by 1 plus I to the power 2. The third installment with 1 plus I to the power 3. Similarly, the n time installment will be discounted by 1 plus I to the power n. So we will be looking at to find out some interest rate that may equate this discounted cash flows of the future that is coming into the installments to the loan value. Okay. So this particular kind of a calculation requires some kind of financial calculators or computer programming. That is something generally not possible by hand. So if you try to do that by hand, you perhaps will not be able to do that. You have to use some kind of financial calculators or some kind of, like computer programming to find out the interest rate that may equate the discounted values of cash flows to the loan value. Something similar happens with the coupon bonds. If the coupon bonds are basically of more than one period, you basically have, if you look at the kind of calculations here, the coupon bond pays you the coupon payments up till the last term, and in the last term basically you get the coupon payment along with the face value. So you discount both the face value and the coupon bond with 1 plus I to the power n. So 1 plus I to the power n basically is something, is the last term discount rate. So if you somehow can use some kind of a calculator or computer program to find out this I, you can find out the YTM for this kind of a coupon bond that basically is there. Similarly, you can do this for consols or perpetuities. The perpetuities are the kind of the bonds that basically are very long term. They don't have got any maturity period inside, basically, right? So a bond with no maturity date that does not repay principal but pays fixed coupon payments forever can be found out. Like here, you can, it's easy to calculate. Like say, for example, here the price is equal to the coupon payments that you get every month or every year divided by the IC. So IC can be found out by dividing C with P. So this is the consoles and bonds calculations are easy to find out. This YTM is a very tricky and very important concept to exactly know that how profitable or unprofitable your investments may be that you are going to make with the money that you have borrowed from some sources. Thank you for joining.